I remember the first time I truly understood what lay beneath the surface of a stock chart. The moment I realized that candles and patterns were nothing more than shadows cast by something far deeper, something older, something that breathed beneath every tick of price. Most young traders believe the market is a game of lines and squiggles. But after 3 decades walking through the wreckage of bubbles and the quiet recovery of forgotten companies, I learned that the real story of a stock isn't written on a chart, it's written in the bones of a business. And that understanding didn't come to me in some classroom or through a best-selling book. It came during the aftermath of the dot-com collapse when I walked into an abandoned office of a once famous startup and found discarded server racks, empty chairs, and a whiteboard still stained with the ghost of a business model that never made sense in the first place. That was when I understood something about fundamental analysis that I've carried with me ever since. Markets can get drunk on hope, charts can paint illusions, but fundamentals tell you the truth even when you don't want to hear it. Back then, I was a chart junkie. Price action was my gospel, volume my compass. But as I sifted through the debris of companies that had promised revolutionary futures with no revenue, no moat, no plan, I felt a quiet shift inside me. I realized that the companies that survived weren't the ones with the prettiest charts or the loudest headlines. They were the ones with real business engines, engines built on cash flow, durable advantages, competent leadership, and the ability to adapt when the world shifted beneath their feet. And so began my long road into the heart of fundamental analysis, a journey that taught me to read not just numbers, but the stories behind those numbers, the quiet signals buried in financial statements that reveal whether a company stands on bedrock or on sand. I remember the first time I sat down with the 10K report, frustrated, overwhelmed, feeling like I was reading a foreign language. But as the years passed and crises came and went, 2008 with its cold, unforgiving hands, and later the pandemic's chaos, I learned that fundamentals weren't dry numbers. They were the heartbeat of the business. They whispered truths the crowd didn't want to believe when everything was euphoric, and they offered calm clarity when panic sent charts into freefall. Over time, patterns began to emerge. Companies with strong free cash flow always found a way through the storms. Firms with real competitive moats, patents, scale, networks, brand, power bent, but didn't break when the economy tightened its grip. Meanwhile, businesses built on hype with no underlying profitability looked like shooting stars. Brilliant for a moment, gone the next. But the lesson that changed me the most came during the depths of the 2008 collapse. I remember the fear god. Everyone remembers that fear. But while the world was panicking, I found myself studying balance sheets the way a doctor studies vital signs. And I saw something remarkable. Some companies weren't dying. They were hurting, yes, but they were alive. Cash reserves strong, debt manageable, margins intact. Their stock prices had crashed, but the businesses themselves were sound. That was when I truly understood that price is not value. Price is the market's mood, but value is the company's truth. And that distinction is the essence of fundamental analysis. You learn to separate noise from substance, panic from opportunity, rumors from reality. You learn to ask deeper questions. Can this company survive a recession? Does it generate real earnings or just accounting illusions? Does management think long-term, or are they inflating short-term numbers to impress investors? Does the business have a moat, or can competitors steal its customers overnight? Those questions have saved my portfolio more times than any chart pattern ever has. And over the years, fundamental analysis became less about formulas and more about intuition. An intuition sharpened by decades of reading, listening, observing how great companies behave under pressure. Charts show you where price has traveled. Fundamentals show you where the business is capable of going. But let me tell you something most traders don't want to admit. Fundamental analysis is emotionally harder than technical analysis because it forces you to slow down, to be patient, to think in years instead of minutes. It strips away the thrill of fast trades and replaces it with the quiet discipline of long-term conviction. And conviction is only as strong as the research you build it on. I've seen traders buy stocks because the chart looks good and then crumble the moment the price dips. But when you understand a business, truly understand it, you stop fearing drawdowns and start evaluating them. You stop asking, why is the price dropping, and start asking, has the business changed? That shift in mindset is the gateway to maturity. I remember analyzing a small manufacturing company during the COVID crash. Its chart looked like a cliff straight down. Most traders avoided it like it carried a plague. But when I dug into the fundamentals, I found a hidden resilience. Healthy balance sheet, strong supplier contracts, a surprising backlog of orders, and leadership that had navigated previous recessions with calm brilliance. The company was wounded, but not broken. And so I invested, not because the chart told me to, but because the fundamentals whispered a truth the market was too panicked to hear. That investment didn't turn me into a billionaire. It didn't explode upward in a week, but it tripled over the next 2 years and taught me once again that fundamentals aren't about prediction, they're about understanding. And understanding is what keeps your hands steady when the world shakes. You learn that earnings season is not a gamble, but a report card. You learn that revenue means nothing without margins, that profit means little without cash flow, that growth is worthless without the capacity to sustain it. You start to see companies not as ticker symbols, but as living organisms, breathing, growing, struggling, adapting. And that perspective changes the way you trade, the way you invest, the way you think about the market itself. Fundamental analysis doesn't give you certainty. Nothing in this game does. But it gives you clarity. And clarity is the closest thing to an edge you'll ever have in a world ruled by fear, greed, and the unpredictable tides of human emotion. Even now, after surviving 3 market cycles that wiped out entire generations of traders, I still sit down with earnings reports the way old sailors study weather maps. Not because it's exciting, not because it's glamorous, but because every line in those reports tells me something about the future resilience of a business, the kind of resilience that charts alone can never reveal. And if you're willing to look beyond the noise, beyond the candles and indicators, beyond the rush of quick trades, you'll begin to see what I saw all those years ago, that fundamental analysis isn't about numbers. It's about understanding the soul of a company, the quiet engine that drives price long after the hype fades. And once you see that, once you learn to listen to the whispers beneath the headlines, you'll find yourself stepping into a deeper, steadier kind of trading, where the goal is no longer to chase the next move, but to understand the enduring value behind the movement itself. And that's the moment when everything in your approach to the market begins to shift in a way that makes you feel as though you finally stepped behind the curtain, seeing the machinery that has always been there but never revealed itself to the impatient. Because once you understand what truly drives a business, the levers of revenue, the weight of debt, the discipline of management, the strength of a moat, you stop treating the market like a casino and start treating it like the long, winding landscape it really is. You begin to carry yourself differently, not because you've become smarter, but because you've become steadier. And steadiness is the rarest currency in this game. I remember the first time I felt that steadiness take hold. It was years after the worst of 2008, when the world was still suspicious of every rally, every earnings announcement, every CEO's smile on CNBC. I was holding shares of a company everyone else seemed eager to dump. The chart looked sick, sentiment was bleak, and the headlines screamed doom. But I had done the work, not the rushed, superficial kind, but the kind built from months of reading footnotes, studying management decisions, comparing margins over time, and questioning every rosy assumption until all that was left was a core truth. The business was stronger than the market believed. And when you reach that point, you stop flinching at volatility. You stop reacting to noise. You stop allowing the crowd to decide the value of what you own. That is the quiet power of fundamental analysis. Over the decades, I learned that every great investor, Buffett, Templeton, Marx, even the ones who rarely talk publicly, shares the same unglamorous obsession. Understanding what a business is truly worth, not what the market says is worth this morning. Price is gossip. Value is character. And the real art lies in the gap between the two. When that gap widens, opportunity emerges not in the flashing lights of a breakout chart, but in the calm conviction that the market will eventually recognize what you already see. But let me tell you something. Most beginners never learn until they've already paid for the lesson. Fundamental analysis isn't simply about buying the right businesses. It's also about knowing which stories to walk away from. There's a kind of seduction in hype-driven companies, especially in bull markets where everything looks like a revolution waiting to happen. I've sat across tables from founders with dazzling visions and no viable path to profit. I've read prospectuses full of poetic promises and empty economics. And every time a young trader told me, this one is different, I'd think back to the graveyard of companies that said the same thing in 1999. Fundamental analysis taught me that dreams don't pay bills, cash flow does. And any company that relies on hope more than discipline is a company built on sand. Yet, the deeper I went into fundamentals, the more I realized something else. Numbers alone aren't enough. A healthy balance sheet can hide a dying culture. Strong revenue can mask poor leadership. Beautiful margins can evaporate if a company loses its edge. That's why true fundamental analysis requires studying the intangibles: management integrity, strategic clarity, adaptability, and the subtle signals hidden in how leaders talk during earnings calls when they're under pressure. Over the years, I learned to listen not just to the words, but to the tone, the hesitations, the confidence, the flickers of discomfort. Markets may discount price instantly, but they recognize truth slowly. And if you train yourself to notice these human elements, you gain an edge that no chart can replicate. One day during the pandemic, I found myself studying two companies in the same sector. On paper, they looked identical: similar revenue, similar margins, similar market cap. But when I dug deeper, their destinies could not have been more different. One had a leadership team that spoke with clarity and humility, acknowledging challenges and outlining practical steps. The other dodged questions, overpromised, and inflated guidance. Their charts both fell during the crash, but only one was worth buying. And sure enough, when the world stabilized, that company recovered like a coiled spring while the other drifted into irrelevance. That experience reminded me once again that fundamentals aren't static numbers, they're living stories. But here's the part few people talk about. Fundamental analysis changes you not just as an investor, but as a person. When you study businesses deeply, you begin to understand people more deeply. You learn patience because value takes time to surface. You learn resilience because the market rarely rewards you immediately. You learn humility because even great companies can stumble and even great analyses can be wrong. And more than anything, you learn to think independently, to hold a conviction that isn't shaken by the crowd's panic or euphoria. That independence is what saved me during the COVID recovery, when the market was roaring back with an almost manic energy. Everyone was chasing high flyers and speculative darlings. The charts looked like rockets leaving Earth's atmosphere. But when I peeled back the layers, I saw fundamentals bending under the weight of unrealistic expectations. So I stayed away. And when many of those names came crashing back to reality, I was reminded of an old truth whispered through every crash and recovery I've lived through. Fundamentals win eventually. They always do. They just don't win on your schedule. And that brings me to the core of what I want you to take from all this. Fundamental analysis isn't the path to quick riches. It's the path to durable wealth. It's the craft of understanding what something is truly worth and having the courage to act on that understanding even when the crowd can't see it yet. It's slow, it's meticulous, it's uncomfortable, and that's why so few people commit to it. But those who do, those who cultivate the discipline to study businesses the way a craftsman studies his materials, find themselves with a clarity that cuts through every bubble and every crash. So if you're standing at the edge of the market, wondering how to move beyond the lines on a chart, let me tell you this: step into the fundamentals. Learn the language of income statements and cash flows. Teach yourself to think like an owner, not a trader chasing the next flicker of price movement. Build convictions grounded in understanding, not excitement. Because the day you stop asking, where is the chart going, and start asking, what is this business becoming, is the day you begin your real evolution as an investor. And if this journey resonates with you, if you felt something shift as you read these words, then take a moment to reflect on what part of your process needs more depth, more patience, more truth. Then share your thoughts with me. Tell me what struck you the most. And if you want more lessons forged from decades in the market's trenches, make sure to follow the channel and leave a comment so we can keep growing through these hard-earned truths together.